Hello and welcome to Intermediate Financial Accounting 1 Tutorial 7b. This is the second of two tutorials on constructing a statement of cash flows. Tutorial 7a emphasized preparation of the operating section of the statement of cash flows using the indirect approach. This tutorial will focus on preparing the investing and financing sections of the statement of cash flows. It is recommended that you review Tutorial A before proceeding. This tutorial has three key learning objectives. First, we will review the components of the statement of cash flows. Second, we will illustrate how to prepare the investing section of a statement of cash flows. And third, we will illustrate how to prepare the financing section of a statement of cash flows. So before proceeding, we'll just briefly review the components of the statement of cash flow as already shown in Tutorial 7a. In Tutorial 7a, we cover the operating activity section, and that's the part that identifies the cash flows generated or used in normal operations of the business. And in this tutorial, we will now focus on the investing activities, which identifies cash generated or used related to non-current assets, and our financing activities, which looks at cash generated or used related to non-current liabilities and equity. And as illustrated in Tutorial 7a, we will need an income statement for the current year in order to construct our statement of cash flows, and a comparative balance sheet, so basically current year and prior year. And again, the source of the changes in current and non-current assets and liabilities comes from the comparative balance sheet. So this tutorial follows the Costanza Corp example on the statement of cash flows, and the requirement was to prepare a statement of cash flows for the year ended December 31st using the indirect approach. Tutorial 7a focused on the operating section, and now we will look at the investing and financing sections. The important point to note here is that the investing and financing sections do not differ based on the indirect approach or the direct approach. So in our example, the indirect approach is really only applicable to the operating section of the statement of cash flows. Now we will pick up where we left off from Tutorial 7a. If you recall, we prepared the operating section for the statement of cash flows, in which we determined that there was a net cash provided by operating activities of $201,000. And now in the rest of this tutorial, we will look at the investing and financing sections. Now that we have completed cash flows from operating activities, we proceed to the next section, which is cash flows from investing activities. And what we do here is we now go through the changes in accounts that are in our non-current assets. In our very simple example, we've basically got property, plant, and equipment. And associated with it is accumulated depreciation. What we do not do, and I'll start this right away, is do not just take the difference between the beginning and ending amounts. Don't do that, because if we go from $2,445,000 to $2,836,000, that's a change of $391,000. And many students make this mistake, and they report this as cash used to purchase or cash from a sale of property, plant, and equipment. By doing that, you're neglecting all of these activities that happen within that account. We cannot just take the difference between the beginning and ending balances like we do with current assets and liabilities. We actually have to do a reconstruction. So reconstruct our non-current accounts. In our example here, we begin with $2,445,000. And during the year, in the data, it says that the company actually acquired some property, plant, and equipment in exchange for shares. Now, this $75,000 transaction is a non-cash transaction. We have to show it in our T account because it's a transaction that actually happened, but it's non-cash. The data also shows us that the company sold some property, plant, and equipment with an original cost of $112,000. So as you can see here, we're already starting to put some items through our T account. In order to figure out how much cash was actually transacted for the purchase of a property, plant, and equipment, we have to plug this T account or come up with a calculated value, which is basically the ending balance of $2,836,000 plus the cost on the disposition. Okay, this is not the proceeds. This $112,000 is not how much cash came from the sale. This is the original cost on that asset. And if you review material from your prerequisite course, you'll recall that we must remove the asset, both its cost and accumulated depreciation, and that gives us net book value, and the difference between the cash proceeds and net book value is a gain or loss. So we take our ending property, plant, and equipment balance, we add back any cost that was removed, and then we subtract any non-cash transactions to purchase assets, and then we subtract the beginning balance. That means the company used $428,000 to purchase property, plant, and equipment. And so that's how that number is arrived at. Please make sure that you understand these numbers before proceeding to the next slide. Next, we want to determine what the cash proceeds were from the sale of any property, plant, and equipment. Some problems will actually tell you that outright. Some problems will require you to do a little work to figure that out. In this case, we have to do a little bit of work. You may notice that property, plant, and equipment accounts on the balance sheet come in pairs. Every asset account is paired with an accumulated depreciation account. So we have to look at reconciling both of those accounts, which we did with the property, plant, and equipment cost account, but now we must do the same for the accumulated depreciation account. In order to figure out the cash from proceeds, we have to use this little formula down here to help us out. If you refer to your previous materials and what I had mentioned in the previous slide, if we take our proceeds minus the net book value or carrying value of an asset, that'll give us a gain or loss. If we know any of these, we can figure out some of the other pieces. So if we know the proceeds and the net book value, we can figure out the gain or loss. Conversely, if we know what the gain or loss is and we know what the net book value is, we can calculate the proceeds. So what we know is that the original cost of the assets sold was $112,000. We showed you that in the previous slide. What we don't know quite yet is the accumulated depreciation on that asset to determine what the net book value is. We have to reconstruct our accumulated depreciation account. So we know from the data that our beginning balance is $1,034,000. And we know also from the data that our ending balance is $1,121,000. So these two are given. What we're also told is that depreciation expense on the income statement is $155,000. And so if we know the beginning and ending balance and we know the depreciation expense, in order to make our T account end up equaling $1,121,000, there must have been something that was a debit transaction. And since an asset was sold, that must be the accumulated depreciation on that asset sold. And so that's where this $68,000 comes in. So our net book value is equal to the $112,000 cost of assets sold less the $68,000 in accumulated depreciation gives us $44,000 in net book value. Now the rest is easy. If I set my proceeds to be X, the unknown, and I say that that's equal to my net book value of $44,000 minus the gain or loss on sale, in this case I have a loss on sale, that means the proceeds had to be $40,000. And you can double check. $40,000 in proceeds less $44,000 in net book value gives a $4,000 loss. So this $4,000 loss was added back in the operating section as a non-cash item. And this cash proceeds is now proven, and we generated $40,000 in sales from some property, plant, and equipment. Even though it was sold at a loss, we were able to get positive cash for it. This may be a little difficult to follow, so before proceeding, please make sure that you're able to trace these numbers through, because this is very important, and you will have to do account reconstructions for basically any problem that you do in the investing section and the financing sections. Okay, so for Costanza, we're done with the investing section, and what we have then is net cash from investing activities of $388,000 outflow, and that's comprised of $428,000 in cash used to purchase property, plant, and equipment, less cash that was generated from the sale of some property, plant, and equipment. So that's the $40,000. And now we move on to our last section, which is cash from financing activities. And in our financing section, or our long-term or non-current liabilities, we have bonds and a mortgage. So we'll begin with the bonds payable. Always look through additional information to see what a question says about what happened in those accounts. So if you look through the data, there's actually nothing outrightly identified for any transactions that happen in bonds payable. So what that usually means is that if we calculate the difference between the beginning and ending balance, that will get us the information that we need all in cash for our bond payable account. So we started the year with $1 million and ended in $800,000. That means there had to be a debit of $200,000, and that was the carrying value of bonds retired. This debit does not necessarily mean that this is the amount of cash that was received. So what we have to do is determine if there was a gain or a loss on the retirement of bonds. And there actually was. And so if we have a little formula here that says, okay, if the carrying value of my bonds less my cash paid, because if you're redeeming bonds, you're going to pay cash. So the difference between those two is a gain or loss. If I know from my account reconstruction that the carrying value of the bonds was $200,000, and if I subtract the cash paid that I don't know, but if I know the difference between those two is supposed to be a $3,000 gain on retirement, and this comes from the income statement. You'll notice that we need information from the income statement to help us figure this stuff out, like the depreciation expense or amortization expense if it's ASPE, any gains or losses associated with the disposal of property, plant, and equipment, bonds, etc. If I set the cash paid equal to Y in this case, I could set it to whatever I like, X, Y, Z, but Y, or cash paid, is equal to the $200,000 carrying value minus the $3,000 gain on retirement. That means the amount of cash paid to retire the bonds was $197,000. Always do a check. $200,000 in carrying value minus the cash paid of $197,000 is a $3,000 gain. And that's what I have here, $197,000 cash paid to retire bonds. Now that we have completed the bond payable, you'll notice that the next item on the balance sheet in the long-term liabilities section relates to the mortgage. The mortgage is actually broken up into current and non-current portions, and even though there's a current portion reported in current liabilities, it still relates to a long-term debt item. So when we do our account reconstructions, that current portion should actually be combined in part of the financing section itself, not part of the activity section, even though it's a current liability. If we refer back to the data, you'll see that there is a combined beginning balance between the current and non-current portions of the mortgage payable of $250,000, comprised of $25,000 in current plus $225,000 non-current. And the same actually is with the $400,000 ending balance. This is comprised of $40,000 current plus $360,000 non-current. So these are where those numbers come from. We're also told that $25,000 in cash was paid on the principal balance, so we can show that right here. Cash paid on mortgage payable, an outflow of $25,000. Now we have enough information to reconstruct the mortgage payable T account, and if you're starting to notice, T accounts are very, very helpful when it comes to doing these account reconstructions. In order to figure out how much cash was generated from the refinancing, we have to calculate that value. So we take the $400,000 ending balance plus the $25,000 principal paid minus the beginning balance, gives us $175,000 cash from the refinance of the mortgage payable. And so we show that separately. Now, you'll notice that even though both of these are related to the mortgage, you may ask, well, why don't we just show $150,000 net cash from the refinance? And the answer is, well, we can't do that. There's two separate events or types of transactions here. One is the payment of the principal on the mortgage, and that's a separate outflow from the $175,000 inflow of refinancing the mortgage. And guess what? That's the same idea up here in the investing section. I didn't mention it earlier, but I am now. Even though we have net cash related to property, plant, and equipment of $388,000, that's comprised of two separate transactions. We must disclose separately cash used to purchase and then any cash from sale of property, plant, and equipment. And if there are different types of transactions, we could have cash to purchase land and then cash from the sale of land, and then cash to purchase equipment and cash from the sale of the equipment. All of those would have to be disclosed separately in this section. Now we are done with all of the non-current liabilities. So now we move on to the shareholders' equity section. Remember, the reason why equity transactions are also included in the financing section is because debt and equity are ways the company raises money, the way it finances itself. It either borrows money or it issues shares. So that's why they're both included in the financing activity section. To determine the amount of cash generated or used for common shares, we have to do an account reconstruction for our common share account. We have a beginning balance of $100,000 and an ending balance of $500,000. Recall that in the account reconstruction for property, plant, and equipment, there were shares issued for $75,000, and those shares are a non-cash transaction. What they do is they increase the value in the share account, and we have to make sure that we include that. And so when we then try to reconcile or reconstruct the T account for common shares, you'll see that we cannot just take the difference between the beginning and ending balances because there is a non-cash transaction here. So when we take the ending balance and we subtract the beginning balance and then take out the $75,000 for the property, plant, and equipment, we are left with $325,000. That must be shares issued for cash. And so we show in our financing activities section cash from common shares issued, or cash from issue of common shares, $325,000. Next up in the balance sheet, you'll see is retained earnings after common shares. Now, we never, ever actually look at changes in retained earnings on the cash flow statement. However, what's important is that we look at the transactions within retained earnings to determine if there are any dividends that are declared, and then ultimately if dividends are paid. There's one item that we haven't looked at yet, and we left in the current liabilities, and that's the dividends payable, and we left that specifically on purpose. So if you're wondering how come we didn't cover the dividends payable in the reconciliation of changes in working capital, that's because dividends relate to equity transactions, and equity transactions are financing items. What we must do to determine how much cash was paid for dividends is reconstruct two accounts. We have to reconstruct the retained earnings and the dividend payable. Now, if there is no dividend payable account, then that means all of the dividends that are declared would actually have been paid as well. Because if there's no amount that's left over to be payable, then they all must have been paid. The first thing we do is reconstruct the retained earnings account. As you can see the pattern, we take our beginning balance and put it in the right side of our T account, and we put our ending balance. And from our income statement, we add our net income. Now we can reconcile the account out and say that, okay, if we take our $347,000 ending balance and subtract the net income and subtract the beginning balance, we'll end up with cash dividends declared. This is important. These are cash dividends declared of $82,000, but dividends declared are not the same as dividends paid because of the payable account. Now, the other item you want to look for in other problems, it doesn't exist in this problem, but in some cases, some problems may have stock or share dividends. Those are also removed from retained earnings, but they are non-cash related. If, for example, in this problem, we said that there was a stock dividend that was declared valued at $40,000, then the cash portion would actually be $42,000. So the total dividends, cash plus stock, would equal $82,000, but only $42,000 would be the cash portion. So in this case, we don't have any stock or share dividends, so all of the dividends declared are cash. And if you recall the journal entries to record this, and you can tell just by looking at it, If I debit my retained earnings, I must credit my dividends payable account. And so the 82,000 dividends declared shows up in here. Now I must reconcile out the dividend payable account the same. I have a $23,000 beginning balance. I add dividends declared, and then I have to take out the ending balance, or you can work backwards. Usually I tell students to work backwards from 35,000, subtract the amount declared, subtract the beginning balance, and that means that we can plug this dividend payable account to say, oh, okay, the amount of cash that had to have been paid was $70,000. And you can see that that's different from the amount of dividends declared. So please make sure that you do account reconstructions for retained earnings and dividends payable. And if there's no dividends payable, then it's one step easier. The cash dividends declared is the same as the amount paid. So what we show here, cash paid for dividends, not declared, $70,000 outflow. So now we are finished with our financing activities section. And what we can see here is that the company generated net cash from financing activities of $208,000. It had positive cash flow from financing activities, and that's comprised of refinancing a mortgage, issuing some shares, and then perhaps using that money to retire bonds, pay down some of the principal in the mortgage, and pay dividends. And then when we look at putting this all together, if we look at the operating activities, the cash generated was $201,000 minus $388,000 from investing activities plus $208,000 in financing activities is a change in cash, or an increase in cash of $21,000. If we've done our work correctly, this should reconcile to the beginning and ending amounts of cash on our balance sheet. And so if we look at our beginning balance sheet, our cash balance was $116,000. So if we take $21,000 change in cash plus the $116,000 at the beginning, that should give us the $137,000, our ending balance. This is the built-in check here. If we arrive at that number, we know we've done it properly. And in this case we have, so we have a little happy face. Here is our completed statement of cash flows for the year ended December 31st for Costanza Corp. This statement is acceptable under both ASPE and IFRS, and it paints an interesting picture. It tells us that the company generated $201,000 in cash from operations, and it undertook some financing activities to generate additional cash of $208,000. And from those funds, it retired some bonds, and we don't know why. There's not a lot of information given, but perhaps the company refinanced the mortgage at a more favorable rate than the bonds, and used some of the proceeds between that and the share issue to retire some of the bonds and pay down perhaps a mandatory portion of the mortgage. And then used the combined money between operations and the investing activities, which was mostly from issuing common shares, to reinvest in the business. So the company purchased $428,000 in property, plant, and equipment, and sold some other equipment. So it could be that the company sold old equipment for $40,000, even though it was at a loss, not a very large loss, but still sold $40,000 worth of equipment, took those proceeds along with some cash from operations and from their financing activities to reinvest back in the business because they anticipate some growth. And so when you see money being put into the business, that's a positive thing, as opposed to perhaps what we might see on some other cash flow statements where companies will actually issue bonds, so increase the bonds, and then use those to repurchase common shares. That's not the case here. But if you look at this and the activity undertaken, it doesn't matter how much the company generated in net income. You can see here $122,000 in net income. However you determine that to be positive or not, it really doesn't matter. The fact is that the company is generating some strong cash flow and perhaps is undertaking the right kinds of things in investing for its future. So even though now we're completed our statement and calculating what the cash flow from operating activities and financing and investing activities are, we have to make sure that we're still disclosing everything we need to. Because we're using the indirect method, we still have to make sure that we disclose the amount of cash paid for interest and cash paid for income taxes are. This is a mandatory disclosure under both ASPE and IFRS and will be shown separately, so we call it supplemental, separately if the indirect method is being used. An additional disclosure that we need is to show that assets that were valued at $75,000 were acquired in exchange for 10,000 common shares. So this is a non-cash transaction, but it's important because it affects both the common shares and affects property, plant, and equipment, so it must be disclosed. Then we show, if any, in this case there is, the cash paid for interest. And the easiest way to determine how much cash was paid for interest and for taxes, those are the two additional items that must be disclosed. The easiest way to do it is to reconstruct a T account. For our interest payable, we have a beginning balance of $99,000, an ending balance of $100,000, and from the income statement, we have interest expense of $84,000. So reconstructing that account gives us $79,000 for cash paid for interest. And then last, cash paid for income taxes of $40,000. Again, done the same way. We take our beginning balance, we add the income tax expense from the income statement provided, we take our ending balance out, and that results in a calculated value of $40,000 cash paid for income taxes. It's always advisable that you double check your math because sometimes students mix these up and put this on the wrong side. So go back to the beginning and say, okay, $35,000 beginning plus $36,000 income tax expense minus $40,000 cash paid should give me an ending balance of $31,000. And if you get that ending balance, you've done it right. The same thing on the interest. $99,000 beginning plus expense of $84,000 minus the cash paid of $79,000 should leave me with $104,000. And if you get them, then you've done it correctly. Always use account reconciliations, and you can do those using T accounts to determine the cash transactions for investing and financing sections. So remember, when we were looking at cash from the sale of assets or cash used to purchase assets, we had to reconstruct both the cost and accumulated depreciation accounts. When we looked at bonds, we had to reconstruct that bond account. Mortgages, we had to reconstruct that mortgage account. Same thing for common and or preferred shares. Remember that we had to reconstruct using a T account the common shares, and we saw that there was a non-cash transaction that was hidden in there that if we just took the difference between the beginning and ending balances, we would miss. And finally, for dividends, cash paid for dividends, we have to reconstruct both the retained earnings to determine how much dividends were declared. And again, we're looking for cash dividends declared. Okay. Sometimes in retained earnings, we can have stock dividends, so watch out for those. And associated with the retained earnings is a dividend payable account. And if there isn't a dividend payable account, then that means that all of the cash dividends declared were paid. Next is that the cash flow statements requires supplemental disclosures. We have to make sure that we include any cash paid for interest, any cash paid for income taxes, and any other non-cash transactions that affect our current assets or liabilities or shareholders' equity accounts. Things like stock dividends, which are non-cash, exchanges of shares for assets, those kinds of things. The next two items are ones we really haven't seen in our example because we can't get it all in there. But this relates to bank overdrafts or short-term bank indebtedness. Bank overdrafts would be overdrawn bank accounts, overdrawn cash accounts. And bank indebtedness is similar, but they are typically revolving lines of credit or facilities that businesses have on a short-term basis to finance their operations. What should happen is those amounts should be netted out against cash and not included as a change in the operating activity section. Could result in cash reported as a negative balance, and that's okay, but we don't look at the change in bank overdraft or bank indebtedness. And then the final item relates to something we haven't seen yet, but that's cash and cash equivalents. Cash equivalents are short-term investments typically, so GICs, term deposits, items that are convertible into a readily known amount of cash within 1 year or less. So very short-term items, not stocks or bonds because especially ones that are traded on the open market, their value can be substantially depressed. But if we're talking about government term deposits, those kinds of things, governments going bankrupt is near impossible. We're very confident in the amount. And so what we do is we take cash equivalents and then combine them with cash. So we add them to cash and we present that as cash and cash equivalents. What we would have then at the very bottom of our statement is the change in cash. And then we have cash and cash equivalents. So we can call that CCE, cash and cash equivalents beginning of a year, plus or minus cash and cash equivalents at the beginning of the year would give us cash and cash equivalents at the end of the year. If you're wondering what cash equivalents are, have a look in the materials. And if they show up in any problems, that's what they represent. So this now concludes Tutorial 7B on preparation of the investing and financing sections of the Statement of Cash Flows.